Hi everyone, I'm Michael Frazis. I'm Portfolio Manager at Frazis Capital Partners. I thought today I'd give you a quick little update, some views on markets. Obviously, there's been a bit of a sell-off in tech, so we can talk about that. I'll also discuss a couple of life sciences things and maybe a few comments on Tesla Battery Day. Now, if you look, there's some way of doing chat and asking questions, so we'll answer any questions that come out. On that note, let me share my screen and show you the presentation. So this is us. We invest in technology and the life sciences. I know most of you are familiar with us, so I'll run through this stuff really quickly. By investing in tech and fast-growing companies, you'll be able to significantly outperform indices while maintaining maintaining a very high organic growth rate of our portfolio companies. So we're looking for the best companies that are growing extremely fast. And that's actually how we find and assess these companies. Our entire portfolio consists of companies that display these three characteristics. So intense customer love, explosive growth, and market leadership. We found that final point is very helpful to make sure we stay in the top companies around the world. And obviously we use growth as kind of an indication of market traction. I think one of the best ways of knowing how competitive something is how well it's going relative to its competitors. So we really try and focus on the data to identify these kinds of things rather than forming our own opinions and being stuck in our own views, which is one of the many traps you can make in financial markets. One point we've been making recently, you can't really ignore these companies. So, we invested in Afterpay maybe 4 years ago. It's created about $20 billion of value. Over that period, most banks lost about that much. A few years ago in Australia, everyone thought like the safe play was to earn your dividends in the big four. And it's resulted in a huge amount of value destruction that's happened, around the world. So in the Australian marketplace. Similarly, US retail, these were value stocks. And so while there's been some amazing new models like Carvana and Shopify that have come out and created huge amounts of value for early backers and even mid to late backers, the US retail index has gone nowhere. Similarly, by using our framework of love and customer growth, we've been able to actually identify 3 car companies that grew in a 50% auto recession. I think it's pretty phenomenal. Like we didn't expect that. We assumed all these companies would shrink in that environment. But it really shows if you start with a customer and focus on that, how effective a framework that could be. This is kind of where we are at the moment. So the Nasdaq's pulled back 13%. It's actually pretty rare. It doesn't happen very often. It's really only, brought us back to where we were 2 or 3 months ago. But remember, these companies are growing the Nasdaq's growth is much slower, but still, every 6 months, it's probably 5 to 10% larger in terms of the size of the companies. We think it's probably healthy. 13% is probably about right. We think we're probably past halfway here. There was a huge speculative run up in the last month with options. I've got this theory that, those options are going to expire worthless and then we'll get the next leg. But I think these are really important times because these are where you want to be adding to positions, carefully reassessing everything, making sure that, you're keeping the book fresh and new. But most importantly, making sure you're properly set for the next upswing. You've got to take, these opportunities are rare. Like, as you can see, the Nasdaq has can grind up year after year after year for good reason. This isn't speculative. These companies are growing. This is like the entire innovation space, or the vast majority of the global innovation space has happened here over the last 10 years in this index. These opportunities are there to be taken, in my view. Obviously, nobody knows what happens next. Markets go down like over the next few months as well as up, of course. And after such a big run, they're 2 steps forward, 1 step back at the best of times. So we could only be halfway or less through the sell-off. But my view and our approach is, when you have these opportunities, you take them because they're fleeting. Like think of how short that period was early in the year to kind of take advantage of these sell-offs. Now there are parts of the market that are red hot. There's red hot software companies. We're identifying companies trading at 2 to 3, 4 times sales. They're growing 100% year on year. And that's kind of where we're investing. I feel like when people think about overvalued markets, they're thinking about these companies growing at 30, 40, 50, 60% that are trading on 40 times sales. Now, those companies are generally, market leaders. They do have that customer love. But the reality is that the price movements happened over the last year, and that was a value uplift. If you caught that, great, but there is a long period of multiple depreciation and contraction ahead for these companies. So the question for them is will they grow fast enough to keep up with that contraction in multiple? my view on how to play those things, these companies like Datadog, Fastly, obviously Snow that just IPO'd. I think you're better off just waiting and seeing what happens and really being careful with your entry point, because we are spoiled for choice at the moment. There's so many fast growing innovative companies that we don't need to go to these red hot ones unless we get in early. You know, Carvana was in the news earlier because the father-son management team, you know, made $5 billion in a day, you know, but we bought that, you know, at a fraction of the current price, you know, maybe 1/6 of it. It's actually happened a few times where you buy something early with these characteristics and then they hit the front pages. You know, C was the number one, you know, performing large cap company. We owned it. Pinduoduo started making headlines long after we bought it. Afterpay, obviously, we got in 2017. You can actually identify these things early. And then, you know, the natural consequence of something that doubles every year is it's in the headlines 3 or 4 years later. But we want to get in early, and we think we found quite a few of these companies. One thing that's really helped us is the life sciences. So this is part where we do a lot of work, and I think some of our best work is done in this space, but it's something we don't talk about very much, partly because it's very hard to kind of know the right level. Like, you don't want to treat people like idiots because people are quite smart. But at the same time, if you just throw out a bunch of jargon, that makes for difficult conversations. So this is 10x Genomics. They basically focus on, they've got a sample, they'll assess every single cell. So if you think about, and basically what they'll do is they'll sell kind of these chromium devices, you know, which could be $50,000 US list price, but then there'll be consumables that need to be purchased every day and software that's needed to analyze the output. But this is becoming a standard in like the top research laboratories and the top pharmaceutical laboratories around the world. And that's like the first stage of like the total market. If you think about, well, this is just a slide that kind of shows how much data they're really pulling. You know, people think about genetics and they think about, you know, your DNA, and we're getting pretty good at that, like very good at that as a species. But it's really the next level that things get really interesting. So you're seeing like obviously with Moderna, the first mRNA treatments coming to market. And mRNA is just like another step from DNA. You've then got the proteins, synthesis, and the interactions of all the different proteins. It's extremely complicated. You know, the genome is complicated. The DNA part is extremely complicated, but that's like the first step of a series of cascading, you know, complexities. And 10x Genomics is one of the people that can help you kind of like map what's going on at all these different levels on a cell-by-cell basis. You know, literally they'll assess every cell in a sample, or can assess every cell in a sample, which is extremely interesting. And the business model is pretty good as well. So as I mentioned, you'll sell an instrument and then you'll sell them consumables. These are richly valued stock. Obviously we got in relatively early on this one. But I like these kinds of companies because they're not trading with the kind of risk. It's not even, you know, for most of the last 10 years, stocks have traded risk on, risk off. Now there's kind of like a whole new growth set of stocks, and they're trading as one. We've been huge beneficiaries. It's probably because there's a huge amount of hot money. These are very cool companies. So when people hit the sell button, these are the things they sell. This is where the retail money comes in. This is where professionals use for the speculative part of their portfolios. The good news is that like when you have these huge runs where all the money just comes in, you don't need a catalyst. Like if these things are performing well, the market's going up, they'll be doing 2 to 3 times the market comfortably. The downside is that, you know, that when the hot money goes, these things get sold off a lot as well. Now I love the life sciences part of our portfolio because we can actually, you know, step away from this, you know, have the high growth, have that really, that dynamic that we're looking for. But it doesn't trade with the rest of the Nasdaq, as you can see. You know, terrible month for the Nasdaq. These companies have continued to grind up, and we expect they probably will do because so few people know about them. But I promise you they will. Can you share a copy of your presentation on your website? Email me and I will share it with you. Which names are you most bullish over the next 3 to 5 years? We've got about 32 stocks in the portfolio. I'd say all of those. But I can give you some actual names. Why don't I do that at the end, actually? Have you studied new sizable positions during this market pullback? These are small positions. We're actually going to focus a lot on the life sciences at the moment. In the last kind of month, what are our new positions? We had a lot of small positions that we increased. So Redbubble was one. I've talked about it in a few meetings. I can't remember if I've talked about it on an email or on a video. But broadly, it's one of those 100% plus growers trading at 2 times sales, more or less, you know. Where comparable in the US is trading at 8 times. And so what you could easily have here is, you know, doubling. It's profitable as well. You have a doubling in multiple as it's doubling in sales and get like a huge performance uplift in the next 6 to 12 months. The risk with that one is that it is an e-commerce play. We're super bullish e-commerce long-term. I think that's pretty consensus. But those names have all run really hard. So you could get like a pullback in that entire sector over the next 6 to 12 months. We think the real winners there would not be the ones that catch the kind of 20, 30% draw, where people get the 200 to 300% increase, over the next few years. That's what we're playing for. So we're not too worried about the market timing on that. But it's very hard to find these like really cheap, very fast growing companies. So Redbubble will be one that I'd draw your attention to. Again, it's run out. Don't run out and buy it, please. But it's just something that's interesting. You can also track its web statistics live. And so it went from like the 950th website 90 days ago, so 3 months ago, to kind of the 500th biggest website. And there's power laws in these things. So, going from the 900th to the 800th to the 700th, obviously it gets harder and harder and harder as you go up 100 positions. So it's a pretty impressive output. And it's an Aussie listed company, but I think it's 6% of its sales are here. So it's a true global two-sided marketplace, which are really hard to make. And once you've got them, they're somewhat defensible. So that's something we've been adding to. And we've also been focusing on life sciences. Any new or old ASX listings to discuss? That will be, I guess, Redbubble. We are looking at some local life sciences. The problem is if I mention life sciences, it's local small cap life sciences, everyone rushes out and buys it. I think if you want to buy stocks, you're probably better sticking with, some of the things like C and Mercado Libre that we have very, very high conviction on. Are there any stocks that you've started positioning recently without getting in prior to a huge run? Look, I think the huge run thing, I think everything's had a huge run since March, but in my opinion, it was a sell-off that was irrational. I've always thought the sell-off was irrational rather than the rally afterwards. Our portfolio companies are growing at 4 to 5% a month. So if we want to buy something, we do the work and we like it, we want to capture that 5% a month. And one thing I think everybody's learned this year is those price increases happen when you least expect. And the only way to guarantee that you capture them is to be invested. So if you're convinced something will be worth 3 times as much in 5 years because it's growing at 100% plus and it's got all these great, exciting things going on, instead of trying to wait or worry that because it's gone up, you shouldn't buy it. Our view is that you should have a position. If you have the view, you should have the position. What next? Why don't I push on a little bit? I can see somebody's raised their hand, but I'm not sure what that actually means. How's the fund performing in September? We're down in September, but we have lost significantly less than the Nasdaq so far. Partly due to our holdings in life sciences. Obviously, Carvana certainly helped the other day when it popped 30%. But I think, we did 15% odd, net, 15.5% net last month. So you're going to be 2 steps forward, 1 step back. But these are like the exciting times. This is where it gets interesting. Market's down 13%, we're down less. We're seeing a lot of new opportunities. It's a really good buying opportunity. We're personally adding to the fund. I think it's also the fact we have 32 positions has really helped us out. We're not swinging as hard as, we have, in years past when we've had 5 large positions and 5 small ones. How much cash does the fund hold? We've got a few percent cash. The way you should think of us as fully invested. When new money comes into the fund, we generally put it to work. That is how you should view us. So if you want to allocate to us, you should assume it's fully invested. Time and time again, that ends up being the right call. You feel kind of silly when the market's down, but over the long term, that is the right answer. And again, this year has been one of those times where all the market time has got tripped up sooner or later. And the people that are consistent, steady, and invested do considerably well. Like I think we're probably like the best performing asset for a lot of our investors. So it's really important that we did that and we'll continue to do that. And, the arguments of saying things have run really hard, I have heard those every single day for the last 10 years. Everything always looks overvalued. It looks overvalued because the best companies, people are projecting into their future because they have such good insight into their past. All the best fast growing companies are deeply, deeply undervalued at today's prices. That I can basically promise you, apart from maybe Snow and those software companies. But even then, if they maintain their numbers for 5 years, you'll get your 3 times. That is all the questions so far. I will push on for a couple more things. So we talked about 10XG. This is another one, Guardant, which we wrote about a year ago. I think we bought in the 60s. It's now 100 plus. So it's had a very good run. These are the people that are trying to do blood tests for cancer. Now there's two good competitors and then a host of people kind of on like a second, third tier. So Guardant is the only listed one. There's another one called Grail, which is backed by, with much fanfare by Bill Gates. It was recently bought by Illumina. They were going to list, which would have been a very interesting IPO, but they're going to stay private. They actually got spun out by Illumina. So Illumina makes the machines that basically does all the genetic testing. There's a number of listed companies on the Nasdaq, in the US, wherever they're listed, who built business models by basically buying Illumina machines and doing genetic analysis. It's interesting they spun out Grail and then have brought it back in for considerably more, but it's definitely the right decision for them because these cancer tests are going to be huge. If you can get a blood test for cancer for all different types once a year and catch things early, it's just one of those diseases that for whatever reason, it's often very treatable if caught early. Like that's just a game changer. Now the issue with cancer tests that the smart people in the world kind of are very aware of, but people outside the community are not, is that you have to be so careful that the test actually improves overall outcomes. So you could do these tests now and find out if you have cancer, but what if you might find out you have a cancer that wouldn't end up killing you, but then puts you through years of chemotherapy, affects your fertility, your lifespan. These are horrible, horrible drugs. If surgery is required, that is also very horrible. And so the problem, the reason so many people are skeptic about diagnostics in the field is the last thing you want is to tell a bunch of people they have, very early stage cancers that may or may not become a real problem because as you can be guaranteed they're going to say, okay, I want the treatment. Sit down with the family, okay, we'll fight through this together. Let's go through the most extreme version of the treatment we can do. And that is often not the right answer. And we really need to know what the right answer is. So if you do one of these early screening tests, does it improve the overall outcome? Once you take into account the people you told, you treated them, is it worth doing? Similarly, if you can't retreat it, you also probably don't want to know. It's probably not going to be very helpful. Actually, that's a different kind of ethical question, but it's a real problem in cancer because of that psyche thing where it's kind of like, okay, you've got breast cancer, you need to fight it. You need to go to the most extreme version. And so there were decades where there was the most outrageous, like most severe surgeries to try and remove it. But it was later found out that almost all those surgeries were pointless because at the time they couldn't catch it early enough. So by the time they were committing these like very severe surgeries, disfiguring people, it wasn't really affecting survivability. But it was very hard. It took a very, very long time and a lot of work to kind of prove that. And actually, I've got a book recommendation for you, which is this one. So if you're interested in this kind of thing, make sure you buy this book, have a read, and you will understand the issue with these kinds of blood tests. Very interesting. It's funny how cancer just captures people's imaginations. But it's really important to do this stuff right. So this is Guardant. So basically what they're doing is they've got a blood test. At the moment, they're kind of at this bottom end where it's kind of, you've got a cancer and it's treatment selection. You're trying to figure out which way to go. You could do a tissue sample or you could take a blood test. If you can do a blood test, it's obviously a lot easier, particularly for cancers you can't really reach. And then basically they'll have to sequence a significant amount of the DNA in that sample. This is why it took them so long to do it. Think how long it took them to do a genome. Imagine getting a drawer of blood where there's just like one or two stray bits of DNA that give the indication that there's a cancer there. If you know what you're looking for, you can do it. And that's why this has been around for a few years. It's an easier task. The next thing is effectively recurrence monitoring. So you know what to look for and you want to try and capture it in the blood long before there's any symptoms or long before it comes up in a scan. Again, it's an easier task because you know what to look for. And this is kind of what's being tested now in the Illumina 1. The Illumina 2 is detecting early stage cancer. And this is obviously the holy grail in the next phase. But these have to be very large tests and they will be scrutinized very heavily for the reasons we just discussed, namely that so careful actually improving outcomes with something that tells people they have cancer because you can be certain that they're going to want treatment once they know. I feel like there's a question. How do I pull that question up? Not disclosing AUM at the moment. What else was there? Yeah, so Tesla had a battery day and were asked to talk about this. Look, this is interesting. The market obviously sold off. I think it was one of those things where, ran up hard and sold off. So it's basically where it was, before the run up to battery day. I don't think you can read too much into it. I think they said they're basically going to try and come out with $25,000 car in 3 years. If anything, that was a bit disappointing because Elon Musk is very optimistic. I mean, that was when they were kind of producing it. But usually he'd say like 1 or 2 years, and then it would be 3. So maybe people are a bit upset that he said 3 and it might be 4 or 5. But he's very right that this is a price thing. There's so many people want Teslas and electric cars. As they lower the price, there will be a response. He also removed the tabs for batteries, which is kind of like the end bits that connect the kind of cathode and anode. And have made this new design, which also looks kind of cool. That reduces the path, the length of time that the electrons need to flow. It's got these kinds of impacts. It also removes a very difficult part of the manufacturing process. So in one line of Tesla's kind of new machine that makes a machine is equivalent to 7 lines elsewhere, because they can move much faster, continuous motion. I think I'll just like kind of emphasize that he's a few years ahead of the competition. It's been very hard for people to catch up, and he's going to do it almost like Amazon, like continually lowering prices, not trying to maximize profits. He's probably going to drive the short sellers continually mad, because every time they get to a point where they could probably make a profit, he'll just lower prices he's making profit actually, EBITDA, but he's not maximizing for that now. He said that he wants his net margins to be 1 to 2%. And that is exactly what we look for in companies. We want people to be innovating, growing super fast, investing heavily, doing really cool technology, and then spending any money they can and getting the next leg of growth. That is exactly what we're looking for. And it's exactly why very smart people short these companies. Like the same reason that people short them it's the same reason why they do so well. It's really interesting. It's very good to be on the right side of this. This is a bit more detail on the various kinds of benefits of their vertical introduction. What's the time at? I might wrap things up there. So as discussed, we really focus on finding these things early, long before they're in the headlines. I think we've got a pretty good track record of getting these. And really this framework of customer love, explosive growth, it gets you the right answer. It gets you into I was speaking to somebody the other day that his family lost, put like many millions of dollars into a short position on Tesla, and then, effectively it doubled and then close it out at 100% loss. You want a framework that gets you the right answer to these questions. Are they buys or they sells, or do you leave them? A lot of people just left them. They said they're like too hard, not sure. There's a bull and a bear case. That was also the wrong decision, because these ended up being some of the best performers in the market. And one final thing to think about is, these things aren't growing in a vacuum. If you got a $50 billion company growing 100%, which we have a number, and global GDP is negative or flat, they're taking that revenue and value from somewhere else. The amount of times, I think you talk about these companies, people go, oh, it's a bit too hard, I don't really understand it. But you need to. Like if you look at your portfolio and it's underperformed, it's probably because these companies have come and just captured all that value. That's why we're so comfortable having all of our money in these kinds of companies, even though other people might think 5 or 10% is a lot in these kinds of companies. These are the winners. These are the ones taking value, but it's coming from somewhere else. Global GDP is roughly flat. It is important. You cannot ignore these companies. And in fact, you should actually specialize in these things. That's my view anyway. That's what we've tried to do. If you want to get in touch with us, have a chat, maybe buy the dip in tech, let us know. You can find me at michael@fraziscapitalpartners.com. Other than that, I will check if there's any more questions and we'll wrap things up. That is it. I hope you guys have an awesome day.